Hello everyone, it's Red with RedDragonLeo.com. This video is for October 11th, 2014. Will there be a stock market crash in 2014? I know a lot of folks are wondering that. I give it about 50% chance that it'll happen this year. But as far as next year, that's a whole nother story. I think we're going to probably crash next year. But as far as this year goes, I think we're looking at a 15 to 20% correction. And I'm going to go over many reasons for that. First, we're going to start with the weekly chart. I borrowed this from the chart pattern traders, Ron Walker. And he just shows he does a really good job at showing these charts, so that's why I like to use them. So anyway, some of the things I want to really point out here to let you know that this is a serious correction and not just at one of these typical 4 to 6% moves that we've been having here, here, here. I mean, they constantly just have these little pullbacks and go back up. And a lot of people are thinking, okay, we're going to turn and go back up. But I definitely do not believe that. And the reason for it is the break of this rising trend line. This blue rising trend line has been supported since 2011, and it just broke. And we're right now hitting, as of Friday, we hit the 40 period moving average at 107.06. It says there. Now I think Monday we're probably going to open down a little bit more and then rally Monday, according to Mr. Top Step's historical facts and stats. Monday has been up 23 out of the last 30 months. For the Monday of the third week of each month, which is options expiration week. So it's a good reason to think it will go up on Monday, but I'm not expecting anything huge. So on the short term, I would look at, let's see, this is the SPY. Let's go ahead and look at the SPX. And obviously I've got a ton of trend lines drawn here, so I do apologize for that. Let's zoom in on this real quick, and we'll get back to this in a little bit. But assuming that we go down here and hit maybe 1900 area, maybe pierce it, I'm not sure how it's going to open. Futures are down a little bit here. They've been down 8 to 10 points here. Sunday night and early Monday morning. But I do think they're going to probably rally back up, and I would suspect they're going to hit this trend line right here. As this trend line slopes down and falls, it's probably going to be around 1920 in the morning. So, and it'll keep falling. So by the end of the day, it might be 1915. So I suspect that this will be a rally point that we're going to have on Monday. And then after that, I think it will dip and go back down again on Tuesday. And then we'll do the old turnaround Tuesday, go up on Wednesday, Thursday, and Friday. Now, Wednesday, Thursday, Friday does have higher percentages of being up than down. The only down day that's been more down than up over the last 30 months has been Tuesday. So that's all the reason to think that we'll probably bottom on Tuesday, and then we're going to go up. Now, how high we go up is obviously dependent upon exactly how far we go down. But if we, obviously I'm off the screen here now, so if it were to stop there, that'd be great. Then we'd just simply subtract the top from the bottom to get our full move down. And which is 2019 minus, let's just give an example, let's just say 1900. You'd have approximately 120 point move down, that'd be approximately 60 points up. We're looking for about a 50% retracement from where the low is. So if we go down to 1890, then maybe it goes up to 1955, 1950 by the end of the week. My speculation is by the end of the week, this trend line will come into play, and we'll hit it into options expiration week, Friday. That's when we'll hit this trend line. But I think it's going to be a wild ride between now and then. So it's going to be a tough one to figure out. But let's get back at the overall big picture, because obviously this smaller picture I have to just update in the comment section of the blog every day, because things do change. But on the big picture here, as you can see, we broke through this rising trend line. Now that blue line is not drawn all the way up there, but if it were drawn up, you could clearly see we broke through it. And then up here, we broke through the RSI. We are now below 50. And the MACDs, as you can see here, are still up in the 30 area. They've got plenty of room to go down. And you can kind of compare it to some of these other moves where we have went down and went negative here, but the MACDs were all the way down to here by the time this bottomed. And considering how far down we already are, you would expect that by the time that we get down to here to the 0 to 10 range, that at that particular time, these MACD histogram bars are going to be pretty deep. They'll probably be deeper than this here because it's going to be a bigger correction. So I do think that we're probably going to go down here maybe negative 15, maybe even negative 20 if it's not on the chart, as you can see. The full stochastics here, as you can see, are just now hitting the 50 area. And I think they're going to go down here to 20 area before they start to bounce and go back up. My speculation is this is going to be all the way through October and into November is what's going to happen before late November before we actually bottom. As far as the bottom, I am thinking around the 1700 area is the low side, and the high side would be 1800. And now let's get to that, and I'll show you that more on the monthly chart because this is the most important one. The monthly chart. I made a ton of annotations on it, as you can see. And basically, the main thing to focus on is right here, this rising trend line of support right here on the monthly. And that's approximately in the mid 1700s. I really can't tell where. It's maybe, I don't know, 1730, 1740. The low 1700s. And again, it also depends on where you draw the line. As you can see down here, the line is cutting through that actual low on, I believe that's a 2011 low. I'm guessing that was the 1074 low. So it's cutting through it. So if you draw the line a little more accurate from the 666 low to here, it might go down as low as 1700. I'm not sure. But the first area to bounce at is obviously this red line here, which is 1795, if it's going to stop it. If it doesn't, then you're just going to keep on going down until you hit this line, and then you should bounce. Now, the question here is, how far? Are we going to go back up and make a new all-time high and start a primary wave 5 up? I hate to tell you, but the charts just don't support a huge five wave, primary wave 5 up, with the move from the 666 low to the high here, the 1300 and something high, that being the primary wave 1, down here for primary wave 2 to 1074, up here for primary wave 3 for 2019, and down here to approximately somewhere in the 1700 area for primary wave 4. The primary wave 5, while it could go anywhere from two or 3 months to 2 or 3 years, these charts just don't support a huge rally. They just don't. So, and I've given you all the reasons here, but basically you just have to compare it to all the other ones. And that would be, for example, here in this area here, you can see that when we finally broke down below the 70 area on the RSI, you can see here that the market did top in 2000 and it crashed. And you can see the same thing on the cross of the MACDs. Once it crossed over for good and started rolling down, it crashed, as well as down here when you started getting close to the 0 line and it finally started going down below it. Again, it crashed. It did the exact same thing here with in the year 2007. You rode on this support line, and once you broke this 70 area again on the monthly RSI, you had to turn down. And as you can see, you started to go down and you finally crashed. And the same thing here on the rate of change. Again, once it went below 0, it crashed. This tells you right here, the way we are heading down towards 0, I don't think we got more than the end of the year before this thing is going to break probably in January. I'm thinking it's going to break. And you can see here also the MACD histogram is getting ready to cross here on the actual red and black lines, and once they cross, as you can see, previous crosses, they did lead to a crash. So everything tells you that if we go down here and either hit this line or this line, either one, when it goes to bounce back up, it is very likely going to look similar to the 2008 period, where you go down for several months and then you bounce back up, but you do not put in a higher high. You simply roll over and you crash. Now, the only way I could see that we could go back up here and maybe put in maybe a double top or get really close to it is if we just go down here and hit 1800. And we go down here and hit this 1800 area, if it's the 795 20 period monthly average. If we hit that, maybe we can go back up, and it would stretch out at that point, January, February, March. It might stretch out into May before it actually made it back up to that top, but I just don't see it at this point. I just don't. It just looks to me like once it goes down here, even if it's here, it almost looks like the same distance that we fell here. And it looks like it's just going to have a 1 or 2 month bounce, basically Christmas rally, December and maybe early January, and then roll back over again. And maybe this time around it goes down and breaks this. That's assuming it don't hit this on the first go around. Literally, it could come down here and hit this on the first go around and then go back up into December and January. Then we see a crash. But it's just not showing any signs. When you look at this here, it's clearly showing that it wants to go negative, and that just doesn't support a big, huge wave 5 up, primary wave 5 up to, I don't know, 3,000 or something insane. That might last 3 years or something like that. It's not being supported right now. The only time the market that I have noticed here that got support was in these little orange boxes here. We had an area where it should have crashed again. You can clearly see it rolled over, it started to go negative. Here, it chopped around the zero line, wanted to go negative. Same thing here. Everything in this area from somewhere in mid 2011 to early 2013, you can clearly see in that area it wanted to go down here and crash. It did. It was up there, wanted to crash. Everything said it wanted to crash. But this was, I believe, the time period when Ben Bernanke came in with either QE2 or the QE3, which we call QE Infinity, the quantitative easing part 3. And they ran the market all the way up to here, just insane levels, and totally manipulated this chart, which obviously put this MACD up here in uncharted territory, higher than this previous one here. I think it got up to almost 150 at one point. The black line did. Now it's rolled over, of course, now, but it's the highest it's ever been. And so you can clearly see at that point right there, it should have pierced that line and crashed. Did not. They manipulated it and kept it going. And after 3 quantitative easing and the last one being absolutely humongous, I just don't see what else that they could come out with next year to save the market. I don't know. I mean, is it possible? I guess there's a slim chance that they could come out with something insane to really push this market up again. But right now, there's nothing in the monthly chart that says that. It says we should be crashing. We hit either this line or this line. We have a bounce for a month or two. If they really drag it out, maybe they can drag it out till May. But my thoughts are it won't bounce, but 1 month, 2 months tops. December here, January there, whatever. And then you roll over and you start crashing down into 2017 before you actually bottom. And you should certainly take out the 666 low before this is all said and done. There's other chartists that show this is a huge megaphone pattern, which I think if you were to go back to let's see, if we do the Dow Jones here chart, and just to give you an example, and we'll go back to 1929 area, I think what you're going to find will freak you out. Didn't mean to do that. But there's like 5,000 on the Dow. And this, I think, comes from 1920, 1929, I think that's where it comes from. Yes, in that area, from the 1929 crash all the way down to the bottom there where they did the currency reset. I haven't even talked about that yet, but yeah, maybe I'll talk about it in a future video. But you know, Lindsey Williams always talks about them, the elite doing a currency reset, global currency reset. I'm still sticking by the mindset that they're not going to do it until the market bottoms, because history shows you that. Right here in 1932, that's when the currency reset was done. That's when President Roosevelt came on TV and said everybody needs to turn in your gold pieces, your $20 gold pieces, and only the fools turned them in. Everybody else kept them. But they shut the banks down for a week or two, and then when they reopened them, they revalued gold at $35. So it'd take you 35 paper dollars to go in there and get your $20 gold piece back. That's the currency reset. But it was done down here at the bottom in 1932. I think the same thing is going to happen here. When this is all said and done and it crashes like this, you could literally see this go out to 2017. The Megaphone pattern would be a draw line here down to here, I guess, and which I have not done. But if I was to do that, it's probably going to project to that area as well. Let's see, by 2017. Yeah, you can just see you extend out and look what you got there. I mean, it's going to be support from these two lows. It's going to be support from this rising trend line, but that's all the way out to 2017. And I don't see any other way that this market is going to play out. I just don't. And this is obviously a big picture. Short term again. Short term as for next week, well, I think again we're going to go down here and retest the futures overnight low from back in August, which was, I think they've actually already hit it, but it was I think 1890, and we've been down to 1884, 82 or something here Sunday night. So it's very likely we're going to see a rally up for like a little A wave up after a gap down Monday morning. We should rally up into end of the day, then roll over Tuesday for like maybe a B wave down, maybe a little lower low or something, or higher low, maybe a double bottom. I'm not sure on that. And then Wednesday, Thursday, Friday, I think you're going to rally up. And there's a multitude of reasons for that, but the one here I wanted to really show you is the open interest. Open interest tells you how many contracts are out there and any given strike price. The market makers have to cover this. So when you have a huge amount that's lopsided on one side, the market makers do not want to pay this out. It's literally like a game of cards in Vegas, and everybody on the table's getting hot, and they're winning against the house. That dealer, if he keeps going, he's probably going to get fired. Well, they don't usually fire him. They usually just change out the dealer so that they lose, the people lose that edge of being hot. When the market here, what they do is when one particular side, the puts or the calls, and people long or short, is heavy on one side, the market makers will manipulate the market in the other direction so they don't have to pay those people. They just steal their money. And I noticed this about 2 weeks ago that the 190s had 556,000 open interest in them. And this 291,000 is what went through Friday. They're trading back and forth. People closing them out, people buying new ones, closing out positions. This really has not went down. 2 weeks ago, it was around this same area. I think it maybe 580,000 on the 190s. And then you have the other ones, 192's got 175,000, 193's 164,000, 167,000, 195, 237,000. Now, you look over on the call side, you got 76,000, 16,000, 19,000, 20,000. Now let me ask you, if you was a market maker, where would you want to pay out all these people, or would you rather pay out all these people? So it just goes to show you that there's very likely a strong reason for them to manipulate the market up to above 195 so that all of these people that with these put holders expire worthless, so they don't have to pay them. This is pinning the SPY and pinning the market. So that would be about 1950 on the SPX. Now that doesn't mean that late day Friday they couldn't, after everybody's kind of out of it and closed out their positions, threw in the towel. The market makers have kind of shuffled their positions around and got comfortable with where they're at, and they don't worry at that point whether the market crashes or not. It's not to say they might turn around and late in the day, Friday, let the thing just collapse and drop hard. And it could very well do that. So I won't say one way or another where it will or won't. So I just don't know. But I do think we're going to get up into that area at some point, Thursday or Friday. Now, here's another thing as far as this is bugging me. This is a possible fake print. The market never hit there. It was at 8 a.m. It's 2:02:45 on the SPY. It happened on September 19th. So anytime you see anything odd out of the ordinary that doesn't look like it's what you call a late fill, to give you an example, these aftermarket ticks right here are just late fills, obviously from earlier in that day. The market was in that range. They're not fake prints. This here is just late fills where the market makers meant to close out a position in this dark blue area where the market was open, and they waited till after hours to close it out. But this one here, the market was never here. It's never here. We've never went to 202.45. That's about 24 and 50 cents on the SPX. Never went there. Went to 2019. This possibly could be a signal to the insiders for the final high into January. I'm just speculating on January, but I'm just saying for the primary wave 5 high. Possibly, if they only go down to, let's say, 1800, if it's just kind of a shallow primary wave 4 down, they could, in December, rally it back up, and maybe January, mid-January, maybe they get it up to that point. I don't know. It also could be some type of shuffling around with the options expiration. They have to reevaluate these because the SPY is technically 1/10 of the SPX, and then the SPX has the cash futures. The futures and the cash, and they're related to each other. And I don't know how they calculate all that, but there could be some kind of issue there as well. So I don't know. But just want to keep that in mind. If we ever do go back up in January or February, and it looks like we're going to crazy highs, let's look at this, revisit this fake print. Now, as far as rituals, many times in the past I've talked about how the elite, I call them the gangsters because they're thieves, murderers, rapists, pigs, reptilians, shapeshifters, whatever. Anyway, I'm not going to go into too much on that. You can do your own research on it, but they're certainly Satan worshipers. But they go to these conferences, and I've noticed in the past about 70% of the time there were important turns on this. I remember one back on May 22nd, I think of 2013. I called it like 2 or 3 months in advance. It was a 33 day, and 33 is a ritual number because it's 33 degree Masons, and they hide in the Freemasons. They call themselves the Illuminati. They hide in the Freemasons, and the most evil ones. I think there's probably good Illuminati members as well, but the most evil ones, they hide, and they go to this Catholic Church thing and pose as Christian worshiping people when they are actually worshiping Satan. But the October 8th through the 17th is the meeting that's going on right now. Now, the 17th is this coming Friday. I think it's a very strong possibility there will be a turn. So I think what we're going to have is an up move into the 17th for like a B wave, with the A wave being the first move down from 2019 to approximately 1880 to 1900 this Monday or Tuesday for the low, then a move up 50% into the 17th, and then you see a huge move down to that possibly 1700 area after that. And that times out perfectly with this with the meeting of this conference. And they're meeting in Israel, as you can see, the Holy Land. So the person that turned me on to that is named Reinhardt. He called the 2008 crash to the day several months in advance. And it was based upon Legatus and some other stuff, and he called it to the day. And so, anyway, it's just something to keep in mind. And let's see, have I covered everything? I think I've covered everything, guys. So, if you got any questions, I guess just shoot me a comment on the blog. and I'll try to get out more posts. Honestly, it's like the bear blogs like myself that's been a bear since 2009. They've just kind of given up right when the market it has topped and the bear is actually returning. That's such is life, I guess. So I haven't given up, but I am posting less new post and just commenting on that particular one and just giving you updates that way with Twitter and things like that. So, but I'll do my best to try to come out with new posts or at least new updates and new videos. Should you guys comment more and you actually want them, then I'll try to do it for you. But anyway, that is it. Thank you for listening to my long video, and I'll see you in the comment section on the blog. Thanks again.